Hello, everyone, and welcome to our live stream. Today we have Anna with us from National Bank of Georgia. Let me just remind you that the summer school has started already in Dilijan in the Central Bank of Armenia, and we have all our students there. So today, Anna is going to present you the risk management approach to monetary policy, in particular the application to the US economy. She will talk about the recent updates by the Global Forecasting School on the case A and case B scenarios. So Anna, please, the floor is yours.
Thank you, Azia, for the introduction. So in today's presentation, I will be applying risk management FPAS Mark II framework approach to the US economy. And we are carrying on the series of presentation, as Azia has mentioned, from the last week. And today I am going to divide our presentation into three parts. So the first part is going to explain how and why we believe in prudent risk management, not only to monitor this policy, but also not for monetary policy, but also many other types of policies. And we should be thinking about macroeconomic policies to guard against what Olivier Blanchard refers to as dark corners. So today I want to provide some context because at the Global Forecasting School last week we had this wonderful discussion with Charles Goodhart, who is a professor at LSE, Adi Brender, who is a head of macro and policy division at the Bank of Israel and who is an expert in this Israel case, and Doug Laxton. So the presentation included last week risks posed by high debt economies like the US, Israel, and many others, where ID showed a case of Israel, which is a country that had a fiscal crisis and they had to fix it up. And Doug showed us last Tuesday that if you cut interest rate in the environment and in this kind of environment, market thinks that you are doing it to keep this debt dynamic stable. What can happen is that market reaction when the risk premium rise, term premium rise, because people want more compensation for this, and this framework is about trying to think about macro policies in general, not just monetary policy. And these macro prudential policies are important to guard against financial instabilities. So now, as part of our regular duties, I'm going to get a bit boring, which means moving on to the second part of my presentation and discussing how we construct case A and case B scenarios, which is mentioned. I will be doing that for the US. And as a part of my final presentation, I would like to briefly discuss as a person who came out of a school last year and has gone through this process of this FPAS Mark II analysis. Just from my perspective, I will be giving a little advice as I will give to somebody out there. Either a non-FPAS central bank like Bank of England or as a person in an FPAS Mark I central bank based on my experiences. So just simply speaking from my experiences, should they develop FPAS Mark I framework first or should they jump straight to FPAS Mark II? I would say that this question, and to answer this question, this all comes down to human capital. And the models are never going to tell you what the answer is. So there is an incredible amount of discretion and judgment. And under these circumstances, how do you know that this discretion and judgment is good? And the only answer is that what's the quality of research and modeling in the institution? So basically, the judgment should have some structure. So it's if the institution can ask these three essential questions, that is provided on my slide, has a staff central bank who can think like economists, and then I would say maybe if pass Mark 1 framework is easier for central bank to adapt, but at the same time, if you get into this sort of FPAS Mark 1 mindset, it might be difficult to escape that mindset. So it's better just to think about developing a system that is as close to the analysis, either as close to the reality that we live in, and this reality we know is very much uncertain, especially currently, and not introducing this fully into the analysis either through excessive attention to the baseline or excessive reliance on the local approximations. Um, it is sort of, in a nutshell, harder to move to the FPAS Mark 2 framework when you have already sort of built up this FPAS Mark 1 mindset. However, here I would be referring to Archem, who has been here last year in summer school, who compared thinking about world as linear, as if we think about the climbing at the road up to the diligence training and the research center where we are currently, and linearizing the road, you might end up in the hospital or even worse. So in this sort of case, to understand these three essential ingredients of any FPAS central bank is essential and crucial. However, whether we should adopt FPAS Mark 1 framework first and then move on to FPAS Mark 2, or straight away jump into FPAS Mark 2 framework, I will be happy to provide this example regarding Czech National Bank's experience, and speaking from my perspective at Global Forecasting School, what we do is we have a case studies, all of us case study countries, and I personally am in charge of the Czech National Bank, and I would like to provide an example of Czech. So when they had in the beginning in 19th century, very much, sorry, in 20th century, very much developed this pegged regime, then they had to move on towards this inflation targeting. And they had very short of time to develop the model for inflation targeting, and they had some mini crisis, and that's why they had to, they were sort of forced to leave this pegged regime. Therefore, they had in a very short time, they were able to develop this inflation targeting model. And they, I would say they did it quite well. And the reason why they did it well, I believe, lies into the human capital. They had very well developed human capital by that time, and very well developed staff who were thinking as an economists, and that's why they were able to manage this transitioning towards inflation targeting as smoothly as possible. However, in contrast to that example, I would like to provide another example which Czech National Bank is currently facing regarding neutral rate. So there is like a lot of discussion whether neutral rate has been should have been revised upwards or not for Czech Republic, and there is this debate that's going on between staff and the board, and we see this issue currently for the Czech National Bank. And in a nutshell, what I wanted to say is that there is a problem currently facing the Czech that is a human capital issues, and that is why this sort of debate regarding neutral rate is something the staff has this sort of model says approach that staff told the board that we already revised this neutral rate, and we are not going to change that in the model because model says like this. So in a nutshell, this human capital is a crucial thing that central banks need, and that is the answer for whether we should adopt FPAS Mark 1 or FPAS Mark 2. There are many other things impacting this question, such as how big is the central bank, for example. So, like for example, for the National Bank of England, who is a huge bank, it's of course much harder for them to adapt, since there is this sort of hierarchy. And also taking Georgian and Armenian example, where Georgia has a single governance decision maker, and while for the National Bank of Armenia they have this board decision making. These sort of examples are also different, where, in terms of adopting FPAS Mark II framework. I personally believe when you have a single governance decision maker, it's a sort of, this process is a bit easier, adopting FPAS Mark II, and or straight away just jumping into FPAS Mark II, since you don't have this sort of a lot of different ideas, and you sort of have more straight line decision maker. Moving on to the case A and case B, how do we eliminate this falling in the baseline, which I've mentioned today? I will be providing also case A and case B analysis of the US, and I would like to say huge thanks to my teammates who have helped throughout past weeks building up this presentation. So. We are there may be people who are just listening for the first time our live streaming, and first, in a nutshell, what FPAS Mark II framework is, that FPAS Mark II framework is a new generation of FPAS Mark II, FPAS for policymakers that are currently facing this sort of raised uncertainties, and it helps policymakers to deal with these challenges. So the question is how it deals. The answer is, firstly, it takes into account this highly elevated uncertain environment and these non-linear linkages. And under FPAS Mark II framework, we follow three major ingredients in policy analysis. Firstly, we try to analyze the current stance of the economy. Secondly, we think about what might be the driving forces of the economy. And that's where our non-traded sticky price inflation measure comes in, which helps us analyze much better compared to FPAS Mark I framework these driving forces behind inflation dynamics, so that policymakers have as much information as possible. And then based on this information, and based on the answers to the first two questions, the third question, and we believe key question, is what policymakers need to do with their policy instruments in order to achieve their policy objectives, which means achieving price stability to anchor inflation and inflation expectations. Right, so here in this regard, the FPAS Mark II framework, as I mentioned, takes into account this highly uncertain environment. And how FPAS Mark II does is to answer very simple and very transparent question. What we do is that we believe it's not time to have this one baseline scenario due to this highly uncertain environment. So we believe just talking about one most probable scenario and communicating this to the public without taking into account this highly elevated uncertain environment leads policymakers to irrelevant outcomes. So here what we do in FPAS Mark II, we abandon baseline scenario world, and we focus on more scenario-based forward guidance. And this term suggested Doug Lasson, this scenario-based forward guidance, where we have scenarios like case A and case B, which are two major and alongside with some taxonomy of shocks like case X and case Y, which are also very important this to take into account these tail risks, because this getting trapped into the dark corners are highly elevated. And as all of you know, this trapped in the dark corners is the term that Blanchard used. And for U.S. Economy, we start analyzing from the U.S. economy due to its size and its huge spillovers all over the world. So it's very important, therefore, to start from the U.S. Economy from the FPAS Mark II perspectives, and we start looking into maybe first the household balance sheet data and credit conditions. And also GDP now estimates. So if we look into the economic activity, we clearly see that economy still appears to be solid. U.S. economy saw some positive data regarding GDP now estimate. It was lowest at around 1.7%. 1.6 GDP now estimate, and it has sort of shifted upwards and sort of has stabilized at 2% standing currently for the quarter to 2024. And if we look at this GDP now estimate for the second quarter data, we see that even in the second quarter, based on these updated projections of the Atlanta Fed, we should expect that this solid economic activity still remains there. And in the second quarter data of this 2%, with the newest update, key question is why has this economic activity in the US been so strong, and what are the drivers of this economic activity to be so solid? And if we look at the consumption expenditure for the GDP, we see that consumption expenditure has been very strong during the recent quarters, and it has stabilized only recently. And so from the US, if we look at the consumption, it has stabilized. However, a huge pent-up demand and this huge fiscal stimulus that we saw during this pandemic due to this monetary easing after 2021, etc., we all know that thinking about recession without a drop in consumption is just unimaginable. And we can see is recession coming, this sort of new presentation by Doug Luxon on Global Forecasting School. Very interesting presentation, and it's quite interesting to discuss about this, whether there are recession signs for the US, and Doug Watson discussed in that presentations. And I would just like to mention that thinking about recession without dropping consumption is just unimaginable. So and this consumption still remains strong, and especially if we look into this consumption, the composition of the GDP, it's still positive. And therefore it's kind of rational to think that in the US, dynamics of for the US as well as for the many other countries, this dynamics of the consumption still remains upwards, especially service consumption in many countries remains strong. And reasons behind this service consumption being very strong is very simple and similar to all these countries, meaning that after the pandemic related restrictions eased, people have this accumulated savings from pandemics, and they follow this sort of revenge spending. And that's why we may see this service consumption being so strong in the US as well as in many other countries. For example, as mentioned in the beginning of the presentation, I have Czech Republic for an analysis, and service consumption remains elevated over there as well. And this is a similar case for Georgia as well, for example. So. In case of GDP now estimates, consumption contributed quite most, and especially service consumption was a key driver. However, I would like to mention here as well that despite this service consumption being a key driver, we don't see a big moderation either in goods consumption as well, especially in case of durables goods, which remains pretty strong. And this solid consumption story, Mariam had very good presentation regarding this solid consumption story. Basically, this happens with this starts from what's happening in the U.S. household balance sheet. If we look into the details of the U.S. household balance sheet, we see very interesting fact here. So, firstly, we see during the pandemic, there was this massive accumulation in wealth in the US households, especially if we compare the end of the 2023 period to the beginning of 2021. We see that total US households' net wealth increased by approximately 50 trillion. To be more precise, today we corrected this number and revised to $53 trillion, very precise number, which is a massive number. And if we want to just imagine how big this number is, we can just look at the US GDP number of, for example, to 2020, and it's like more than double of the US GDP. And this whole solid households balance sheet in the US was approximately driven by massive accumulation in both financial and non-financial wealth. So under financial wealth, we know that we mean stock market, and in case of non-financial wealth, we mean this real estate sector, which both has significantly accumulated. So let's first focus on the stock market and what led the US financial wealth to increase. uh, as you can see on the graph, after beginning of the pandemic, there was this slight drop in the stock market prices, but then it started to accumulate. Firstly, it was for sure just reinforced by eased monetary policy conditions. But despite this, once Fed started to tighten its monetary policy in 2022, this tightening policy, at first, we saw some correction in the stock market, right? And in the latest numbers, we clearly see that asset prices peaked its maximum over the last years. So this massive asset prices basically translated into accumulated financial wealth of the US households, which in turn just increased this net wealth of the US households. And on the other hand, as I mentioned, we had there increased non-financial wealth, such as house prices as well, which significantly increased in the US, and this also got translated into accumulation of the non-financial wealth in US among US households. So in the end, the picture that we got was this massive accumulation in both financial and non-financial wealth. And I would like to also mention this solid household balance sheet is not directly impacting this consumption. Maybe it's not a direct causation or correlation, but this creates buffers for the US households, US consumers to feel confident to keep spending money, despite the fact that we don't have data for this. For the third quarter of 2024 for this GDP now estimates yet. So next quarter is quite interesting for the data, what will happen. However, from the current stance, we can still tell that given these dynamics in the asset prices, household balance sheet will still be solid, in my personal opinion, and this will in turn help us to explain what's happening in the US economics in terms of solid economic activity, which is also exacerbated exacerbates these underlying inflationary pressures, supporting our case A type of scenario. And this is exactly reflected in the sticky price inflation. So if we look at the dynamics into the sticky price inflation, we will clearly see that recently 3 month over 3 month inflation declines. However, it still stands at around 4%. Unfortunately, we don't really have very recent updated data for the sticky price inflation. However, we are expected to get it very shortly. And this 4% is still far above the 2% target, which is, we know, for the US PCE is they have inflation target of 2% PCE. So this 4% sticky price inflation is well above. And also, if we look at the year over year estimate, we still see that it's elevated and it's also above this 2% target. And while its moderation pace is very slow, we are still expecting this sticky price inflation to sort of remain above the target, because these demand side pressures, and especially the solid consumption in the service sector, exactly just hinders underlying inflation pressures, because we know that service consumption exactly draws this sticky price inflation. And as mentioned, this 2% GDP now estimate, which is above the CBO estimate, for example, of potential growth. CBO's estimate for potential growth is 1.8%. So this GDP now estimate of 2% still leads us thinking that demand side pressures will be serious challenge for the Fed to moderate. And that's why maybe we see Fed still maintaining this higher monetary policy stance for a longer period. But the key question, and I would like to mention here that at Global Forecasting School, we don't like this sort of just descriptive statistical analysis, but we sort of would like to see everything critically and ask a question. So key question from us as a Global Forecasting School student perspective is that, is this policy stance of the Fed enough to moderate these highly increased demand side inflationary forces? If we just elaborate more in terms of neutral rate, which is unobservable, and we can only judge from the neutral, from the fundamental factors, these current conditions and this challenging uncertainty, neutral rate is increased, and we may say that current stance may not be enough from the Fed. But if we follow from the Fed's communication that the long-term rate will stand at around 2.5 to 3%, then we say that maybe there is just some lagging issues in the monetary policy transmission mechanism, and maybe in the later stages, we will see some deceleration in the demand side pressures. And however, in the end, everything is uncertain, and that's why we are trying to think about all this and analyze everything from critical side. Additionally, it's very important from global forecasting schools perspective that so for example, in one of latest presentations, Mariam has discussed about commodity prices and this sort of car prices, whether it has been shifted upwards, or it has been just increased, or whether there has been a shift. So, however, speaking about these demand side pressures, which is from FPAS Mark II perspective, our case A sort of type of inflationary case. In the US, demand side story is very interesting. However, it's and very interesting and uncertain, especially recently. Um, in case of the labor market, story it becomes also very interesting from the supply side as well, because the labor market sends very uncertain messages. And if we look at the sort of maybe beverage curve that shows the relationship between the vacancy rate and yes, so if we look at the beverage curve, which shows us the relationship between the vacancy rate in the US and the unemployment rate, we will see that it started to shift inwards, which means that this tightness in the labor market more or less eased. However, if we look at the wage dynamics, we can see that wage still remains elevated, I would say, and wage dynamics remains high, and growth of the average hourly earnings exceeds the CPI inflation, and we see the wage price spiral risk is still there. However, I would like to also mention here that this data has been previously only updated in May, April. We see latest estimates, and unfortunately, we don't really have a data for June or July. So it's we should bear that in mind as well. So. Moving on to the dynamics of the financial conditions are currently pretty restrictive, meaning that it moderates these demand side pressures, and based on bank lending tightness index, which recently started to raise again, if we look at the composition, we see financial conditions being tight in case of, for example, business and consumer loans, which results in the moderation of consumer and real estate loans, and increased interest rates also helps this demand side pressure moderation. That is why we see this downwards dynamic maybe in case of loans in the US, which leads us to think that if it continues this way, then it will somehow just ease these demand side pressures, which I have been discussing for the case A scenario. And this analysis of financial conditions more or less fits our case B perspective under FPAS Mark II framework. And under FPAS Mark II, market reference and what market thinks is very crucial. And if we look at the market probability tracker of the Atlanta Fed, we clearly see that market participants has now revised downwards longer term interest rates expectations, and their long term the fact that Fed will be maybe cutting rates in September, the sort of expectations for that has been a bit more than even 70% for the Fed rate cuts. And, uh, and now, apart from that, there are some fundamental factors, including these fiscal related issues, this AI development that leads us to think that maybe neutral rate is high in the US, and Fed will struggle to keep interest rate for the longer term at low level. And currently, what we see in the market is what market thinks is that Fed will have maybe in a first cut in the next quarter, and the moderation of the policy path will sort of start. And after Fed's recent communication, we may only see this one rate cut in September, but however, there could be maybe beginning of the next year as well. Just it all depends. Maybe the data for this ticket price inflation, which has not come up yet. However, we have a moderation in GDP now estimate, and at the same time, we don't really have updated data for this wage growth tracker as well. And these two factors are maybe what's sort of uncertain majorly currently in the US. So now maybe we can briefly sum up our case A and case B scenarios, starting from case A. Given that there are these strong demand side pressures, we think that strong demand may persist, and this stronger demand will be exactly fueled by this solid household balance sheet. And if we don't see a moderation in asset prices, which can be validated by higher neutral rate currently, we may still stick to this case A scenario, because with these high asset prices will ultimately be translated into still solid household balance sheet, and this can fuel consumption. So additionally, as mentioned, the wage growth dynamic still is high and leads us to think that labor market remains maybe tight. But in case of case B scenario, we can think that these tight financial conditions will just impact these demand side pressures, and soon we'll be just observing moderation in economic activity, and maybe there is just some lag uh, from this Fed policy rate, and maybe due to this lag, that is why we are seeing this GDP now moderation sort of now. However, I would like to mention here that still this 2% GDP now estimate is higher than the CBO estimate, which is 1.8%, so still sort of inflationary. And recently we are seeing rates of several loans increasing, and this means that financial conditions may further be tightened as the risk appetite of the commercial banks further decrease. And this could be translated into lower credits and then ultimately into the lower consumption. Labor market also slightly indicates that maybe we will see some moderation from supply side pressures as well. So based on all this, we can think that under case A scenario, Fed funds rate will increase slightly, or maybe it just stays at the current level for longer period. Um, Additionally, under case A scenario, we say that the strong economic activity remains longer. It may turn into higher real rates because investors will demand higher real rates for longer term, and this will be translated into an increased premium. So also in case A, um, we do believe that maybe this in this 2% GDP now estimate for case A, this 2% is still higher than CBO estimate is mentioned. And under case B, however, which is below the market reference scenario, we follow more of a dovish scenario, and we believe developments in the US will be a bit less inflationary. We may see that Fed will just decrease its rate faster than currently market expects, and these tight financial conditions that currently US economy is facing will help US in this regard, and this asset prices drop in asset prices there may be a drop in asset prices as well. Well, we're not sure, to be honest. The world is quite uncertain as I started from my presentation, and we may see some big corrections in stock market, which will be translated into lower consumption in the end. And As a result, we believe that in case of case B scenario, inflation will be lower than the target in short term, and then it will just moderate and go back to the target over medium term. So um, however, under case A, case B at Global Forecasting School, we as soon as we receive any new information, we update our analysis. And as mentioned, still there are some data issues, especially for the labor market, for example, is also for this sticky price inflation, which we have not updated very recently. So I'm just like hoping to get the updates for that and then maybe deliver more precise presentation next week. Regarding this case A, case B, we will also have some updates. So I will just suggest to stay tuned. Thank you.
Thanks, Anna. That was very interesting and so on. Annie, do you have a question?
Yeah, I wanted to clarify something. So, do I understand it right? They plan to further cut the interest rates?
Sorry, I did not really understand the question.
Okay. Can you hear me? Sorry, it was technically. Yeah, so I wanted to understand it better. Do they plan to cut further, like cut the interest rate because they believe that these tight financial conditions will eventually cool down the labor market, even though right now it is still tight? Am I understanding it correctly?
Well, I would like to say that market has definitely revised their perception and maybe just from this, if they think this interest rate cuts will be from the Fed, is maybe only based on this Fed's Atlanta Fed's GDP now estimate, because to be honest, I don't think personally I don't believe that U.S. Fed has enough information for them to start thinking about cutting the interest rate, because firstly they don't have updated sticky price inflation measure, they don't have updated wage growth tracker. So I just suggest it's maybe early to speak about that. However, coming from this really big uncertainty, which is from this for example BLT index, which is quite tight, then yes. However, at the same time, if we analyze BWA index, then sort of there is a diversity and uncertainty between BWA index and BLT index, which maybe Doug will explain a bit better.
Can I jump in here? Sorry. Thanks, Anna. Maybe while we were working on these cases, maybe regarding the current revised down probabilities for the Fed's rate cut is stemming from the current inflation, in addition to what Anna said, because we know that in June the CPI number and core PCE number, that is kind of one of the favorite measures of Fed, just showed up really lower than we expected previously at the GFS, for example. And also there is kind of unemployment related issues, right? Because we know that in June, unemployment stood at 4.1, slightly increased. So it's kind of that the case that maybe market perceive that there is kind of soft landing scenario. That is like the most desirable scenario for the Fed, right? Because it can just reach that 2% target without harming economy too much. So maybe this is something that we see in the market expectations. That's why we see that the probability of the rate cut increased for the upcoming meeting. If this, yeah.
Thank you. Thank you for your presentation. It was interesting.
So I just want to jump in here because we're running quite a bit behind here, and we have another event, okay, at 5 p.m., okay, where Yuri is going to be interviewing Miriam, Shelva, and I, okay, about FPAS-Mark II, and we'll be talking about the Case A and the Case B scenarios at that session, Miriam. So I think what we need to do is maybe take a break now, okay? And then if we could all come back just before 5 o'clock, okay? Yuri is going to be interviewing us. And at the very end, okay, I was hoping that we could talk about the role of the Global Forecasting School and the summer school, okay? And what I'd like you guys to do is at that point that we talk about the issues, very frankly, that we've been facing, okay? Dealing with, you know, how we build the market reference scenario, how we build Case A and Case B and X and Y scenarios then, okay? So, and it would be really nice if you guys participated in those discussions. So I will send the questions to people, but I don't think that we really have time now for Miriam to complete her presentation now, and then repeat the same messages at 5 o'clock and so on. So I want you guys to get, you know, some rest, go get some coffee and so on. Of course, I would like, you know, that we have our audio files, okay, that basically try to explain to us what your strategy is for preparing a presentation. So Anna will send her slides to you, okay, and you can think about how you would prepare a presentation to a mock monetary policy committee, okay, that would be 20 minutes long, okay, explaining the essential ingredients of any forecasting and policy analysis system, as well as the types of data that you've looked at to motivate different scenarios and so on, okay? So we'll have a big break. You can take a break now, send your audio file within 15 minutes, and then come back just before 5 o'clock, and then we'll have this session with Yuri, okay, where he's going to interview Miriam, Shelva, and me principally, okay, but at the end, when we move to the issue about what the role of the Global Forecasting School is and the summer school, it would be wonderful to have participation from anybody that would like to either participate in terms of comments or ask questions or whatever. Okay. Okay. Thank you, Anna. And thank you, Annie, for your questions. So we'll see you at 5 o'clock.